Next is, for track one, okay, we'll let people get situated. All right, our next discussion is regarding thriving in the war for deposits and how to drive strategically significant core deposits at half the cost. So we have an industry expert, Alisha Crafton, Chief Growth Officer for KASASA. Please come to the stage and we will get started.
Yes, thank you. Awesome. Hello, how is everybody doing? You doing okay? All right, so yesterday, because it's 2:45 and we're in the afternoon, right? I went on Southwest and they do this thing called airplane yoga. So I'm going to ask you to respond. So how many of you guys, if you think about, we can't talk about the financial services industry without realizing there's a lot of change happening. I think we've talked about that. How many of you would say, hey, I'm seeing significant shifts. I'm seeing changes in consumer behavior. We need deposits. Things are moving quickly, and they're moving more quickly than they ever have. So we cannot talk about or be in the financial industry without being able to address how we can compete from a deposit growth perspective. So the truth is that there's a ton of competition in this area. So I want to talk about how you really can dive in, drive strategically significant deposits. And when I say that, it's like CD-like volumes using maybe a different instrument than we've used in the past. So as I kind of dive in today, we have to talk about what's the real challenge. What's happening as we think about this war, when we think about everybody trying to drive deposits, what's happening in the industry? So what we did is we actually went out and we looked at banks and credit unions that don't currently partner with KASASA, looked at their balance sheets and did an analysis to kind of see what was happening. The first thing that we found is that there was about 56 basis points or so of total deposit runoff. Now, when you see 56 basis points, you're kind of like, that doesn't seem like that much. That actually represents over $2 trillion in deposits. Some of that was consumer spending. Some of that was churn within their own portfolio, so repricing of deposits. But what ended up happening is some of that was actually, when we think about what Apple did, partnering with Goldman and soaking up almost $10 billion of deposits within 3 months. So when we think about digital, when we think about consumers, when we think about this war for deposits, we can't think about them as separate things. We have to think about them as integrated. So that's what we're going to talk about today. So you see that deposit bleed off. Well, how do institutions respond? I was a banker in my prior life, so what do we get taught when we go to banking school or CUNA management school? We're taught, well, if you need liquidity, what do? You pull a CD promotion, right? Or you pull a high-rate savings account. Those things seem great, but they're very expensive, and they're one-hit wonders, right? So what did the industry do? We saw an increase with these people who didn't partner with us of over 117% in time deposits, so CD dollars that were coming in. Those are very expensive. So what does that do to a balance sheet? Cost of funds increases on average around 200%, right? You get some that are even higher than that, so it's significantly expensive. So while you'll see some increases in lending, when I look at balance sheets across the nation, what ends up happening is that net interest margin starts to get eaten up by the interest expense, and in most cases, when you watch it, the pace is very different. Your pace of interest expense is outpacing margin, right? So this becomes really, really expensive, and it's not that fun to market a CD, let's be honest, right? It's not that attractive. So what do? Now, not everybody in that industry shrunk. When we look at that cohort, there were some folks that grew. But the folks that grew had a 221 basis point increase in their cost of funds. Why was that? Because they did things like federal home loan borrowings, right? So still, you're getting some money on, you're getting some liquidity on, but still very expensive, in most cases 485 basis points. So very, very costly. And that was a 6.5 time increase from the 5 consecutive quarters before. So what we're seeing is this need for this deposit, but a super rapid increase in overall cost, right? Which becomes really unmanageable as you think about how we continue. And, for any marketers in the room, that hits budgets, that hits what you're able to do, right? And so what do? What does that create? If we're out there marketing CDs, if we're out there marketing savings, if we're out there trying to do all of this behavior to make sure that when we have a marketing product or service, or we have a CD that comes up, that we can get that person not to leave, what ends up happening, we're actually creating rate shoppers. When I was in banking, I spent some time at Chase, and we used to call these our blue-haired tornadoes. These were the little ladies that would come in and say, what have you done for me lately, right? This is the here today, gone tomorrow money. So what are you doing, right? That creates even more high cost of funds, repricing of existing deposits. You get single product households, and in some cases, you have somebody who maybe had money in a money market or a savings account that now stuck it in a CD. Guess what you've just done? You've just taken somebody who was more core and made them less core, right? Because now it's easier for them to leave. And if they had a checking account with you and they move all that money and then they don't really use that as their primary savings account or their primary institution, it's that much easier for SoFi, for Chime, for somebody else to step in and steal that consumer relationship, which has already been bifurcated. What we also find in that is a lot of unengaged relationships. So when I'm doing balance sheet analysis, and our team is, when we're looking at credit unions, when we're looking at institutions, a lot of times this happens in credit unions if you look at indirect portfolios, is there's a lot of single product households. And they end up staying there, and it's really hard to get those relationships converted. And what ends up happening is you see high levels of attrition. You see people that they start to taper off and they stop engaging so much. And this concept of primary financial institution is getting weaker and weaker and weaker in what's happening. And that creates ongoing liquidity struggles. So here at KASASA, what we call that is phantom growth. A lot of times when you have different products and services that you put out there, you can say, we're growing net new customers, we're growing net new members, look, we're growing these deposits and we're responding. The truth is, if you peel the onion back, it's kind of yucky growth, right? It's not actually creating what you really want to create. And so it's time for a new approach. And so when we look at that cohort, right, those cohort of institutions that did not partner with us, and we compare that to our over 600 partners that power the solution I'm going to talk about here in a moment, what we saw was significant difference. Our clients during that same time period grew 4.11%. That's a 5-time increase in total deposit volume and 2/3 less on CDs. I'm asset liability certified, so I know the importance of CDs on your balance sheet. They have their place, but what if you could grow 2/3 less? What if you didn't have to rely on them as much and you could actually instead drive engaged core deposits? And what that did is they actually, when growing 5 times more, their cost of funds was 30% lower. And they had a product that was throwing off non-interest income at the same time. So that's a significant balance and an impact to your overall balance sheet. So when we think about what's growth, right, what is real growth and what should that look like, I told you what the enemy was. The villain is phantom growth. So when we say you need to look at a way to drive real growth, what does that mean? Now, there's a lot of different ways you could look at profitability models. There's a lot of different things you could do, and you say, is this the type of customer or member that we want? There's a lot of different programs out there, but the truth is, unless it does all of these things, right, unless it is more non-interest income, higher average balances, somebody who's going to take more loans with you and be that core relationship, it's not real growth. And there's a lot of programs out there that you can get some of these things, but if you're not getting all of these things, what will happen as the rate environment changes is you're going to have another phantom growth problem in some way, whether it's margin, whether it's attrition, whether it's overall income. Right? So you have to make sure when you're looking at it holistically on both sides of the balance sheet. We get questions all the time about what do you think is going to happen in the rate environment. I think that, 2 months ago, people thought I was crazy when I said I don't think rates are going to really go down, and if they do, they're coming back up. But now, based on what the Fed has been doing, you guys will hear more of that. That while they may drop 2, 3, maybe more times, next year, because of inflation rates, they're probably going to go back up. And the truth of the matter is that probably we won't see the rate environment like we did for another 10 years. So when you're thinking about how am I going to compete, a lot of institutions I talk to right now are kind of like, we'll just wait it out. Well, don't wait it out because you won't exist if you do, right? So we've got to lean into what's happening and change and do something different. So after doing this for 20 years, we have figured out that there is a 3-pronged approach to driving real growth. And these are metrics that we hold ourselves accountable to, right? That first piece is we have to change the math. So we have to increase core deposits strategically in a very different way, which is where I'm going to spend most of my time today. The problem is a lot of institutions stop here. A lot of product teams are like, hey, we're just going to roll out this product. We're going to build it as a one-time thing. Nothing you do can be a set it and forget it. Nothing you do can be set and forget it. You have to be able to have the product, have the design, make sure it's going to the right consumers, go to market in a way that actually drives action, right, and activity. And then we also have to manage surprises. This is the most important piece right now that I've been really sharing with a lot of institutions is changes will happen. There's no doubt that the Fed's going to change or they're going to do different things. Compliance and regulation is never going to get easier. I know we all wish it would. So how do we adapt? Well, you have to have a consultant. You have to have somebody who can look at data and not just say, like, this is reporting, this is what's going on, but how do I have that consulting engagement to know what to do with it? Data is one thing. Knowing what to do with it is a completely different thing. All right, so how does it work? Regardless of whether you're looking at a new product or service, whether it's a digital offering, whether it's a checking offering, these things have to collide. They have to come together. The first thing that you need in any product or service that's going to help you compete is value for the consumer, right? And that it's going to make them behave in the way that you want to. Well, to do that, you have to actually understand how consumer behavior has changed, right? The other thing is, we know with our client base especially that we have to make sure that's tailored to strategic goals, that's tailored to the balance sheet. We have a very fundamental process after 20 years of being able to take data, a balance sheet, and really trigger it to say, hey, if we do this and this and this, this is what's going to happen to your ROA, this is what's going to happen to your margin, this is what's going to happen, right? From an asset liability modeling, it's not just, hey, we can get this product and we have an idea of what's going to happen in the next year, which is every performer you ever get, right? Or you ever look at, and so if you're a partner, you need to look at that too. The other thing is whatever you roll out always has to be easy for the consumer. It has to be easy for that financial institution. Otherwise, adoption falls off. We talk to people all the time who say, well, we tried something and it didn't work. Well, usually it's not the ones and zeros. It's the people. It's the buy-in. It's when somebody else touches that. So what are we doing all the way from executive team to the front line and to the end consumer to make sure that there is buy-in and execution at every step of the way? Because otherwise it falls apart, right? And so that's what creates real growth. The behavioral economics of that value is a big part of what we do. We spend a lot of time doing consumer research. Example, and this may not feel like it has nothing to do with financial institutions, but it does, is did you guys know, how many of you guys are aware of this, the Salvation Army Santas, the ones that like ring their bell at Christmas time? Yeah. Did you know that if they stand at the top of an escalator, not the bottom, they make more? And also, did you know if you actually have a hot cup of coffee, hot cup of tea in your hand, you're more willing to help somebody than if you have iced coffee. You're kind of more reserved and don't want to help, right? These are human behavioral economics, and I think sometimes in the financial industry, we forget that retailers, and honestly, Vegas does it a little better than we do, right? And so how could we learn and use behavioral economics to change consumer behavior? And then financial engineering, again, if it doesn't make sense for the institution from an economic financial perspective, don't do it. And user experience has to be innovative, smooth, easy access, okay? So, how's it work? The best way to describe the way that this works is to put you in the shoes of a consumer. So let's say that the consumer walks into XYZ institution, they sit down, the banker says, hey, welcome in to ABC Bank. Because you're a valuable customer, you get a basic free checking account. If you do some things that you're probably already doing, like swipe your debit card 15 times, access mobile banking, take an e-statement, you actually get access to a couple of rewards. The first reward you get, nationwide ATM refunds. Every ATM is our ATM. Scale, accessibility, wherever you go, as long as you qualify, we'll refund that to you. The second reward you get is based on what's most important to you. And so let me show you how that works. What will happen then is as soon as that frontline employee opens the account, a text message will go out to the end consumer. Now, where you see KASASA checking, we have about 500 of our clients that use the KASASA brand. This is a marketing conference. We can go into a long discussion about why they do that. But we also have a subset of clients that private label this. They can call this super cool checking, whatever you want to name it. I'm not the marketer in the room. My CMO in the background is like cringing right now. But in your institution's name, right? So it comes from the institution to the end consumer, and it says, hey, click here to choose the reward that's most meaningful to you. So they click that. What happens? Well, they go into the SSO, single sign-on integration, into mobile and online banking. So it is the institution's experience. What does that do? Well, most institutions I talk to say that they only have about 47% mobile or online banking adoption and engagement in their membership or customer base. This pushes them into that integration. So if they haven't opted in, they opt in right on the spot. And then guess what? When they get there, what they'll do is they'll get to choose a reward that's meaningful to them. Let's assume that that member, which I'll show here in just a moment, or customer walks out and they haven't selected their reward. We'll send emails, those types of things, nurture campaign in the mobile online banking to encourage them to do it. Well, why would we do that? Because of some of the profitability metrics I'll show you here in a moment. So the consumer goes in, they log into their SSO, and then they get the option to choose a reward. So an example is, hey, maybe if you qualify, you get 6% on your free checking account up to the first $25,000. Anything above that, you get 50 basis points. If you don't qualify, guess what? It's still free, and you get 5 basis points. So we're educating the consumer. But what if maybe interest isn't important to them? Maybe they prefer cash back on their debit card purchases, maybe 5 or 6% on that, or streaming services, or local grocery, or Uber Eats, food delivery. So what happens in this experience is the consumer comes in and they say, hey, this is meaningful to me. And it's something that's attention-getting. Imagine putting 6%, 7% on a billboard. That's going to get some attention, which is what we've seen over the years. Now, what ends up happening after that is we don't want to stop at the checking account, which I'll show here in a moment for profitability reasons. We want to encourage them to also say, hey, guess what? You can save more. You can also get, if you qualify and you attach a high-yield savings, you can get 4% up to $75,000, 50 basis points above, 5 basis points if you don't qualify. Now, I want to pause for just a moment. I'm going to show you in a moment how you're not actually paying a full 6% on all these deposit dollars. But what's really different about this experience is when they're able to add that savings account, which you're actually going to see, because most of the time what you see is a free or very low rate checking, high rate savings account. Remember the behavior economics I talked to you about? After doing this for 20 years, what we figured out is most people, even if their promoter rate is higher in their checking, lower in their savings, they will put most of their money in their savings. Well, why? Well, let me tell you a story. My institution that I work with in Austin, Texas, came out with a 6% promoted yield on the high yield, 4% on the savings. Guess what I did? I called my husband, and I said, hey, you know all those accounts we have places that I'm not going to mention in this meeting? I said, do you want to close all those? We need to bring all of our money to this institution, who was our client. And he said, okay, and we moved his direct deposit and all that stuff. Guess what I did? I kept about $5,000 in our checking, even though I was earning 6%, and put the rest in my 4%. Many CFOs, when I talk to, are like, why would you do that? Well, because my husband's a welder. He's not in banking. And he loves golf. So guess what happens? As soon as he sees more than $5,000 in a checking account, he bought some new golf clubs. We don't do that anymore, right? So putting it all in the savings is the same thing that happens with consumers, because they don't want to do that. But it's in giving them a high rate of interest if they're engaged with the institution. And then we want to give them real-time access in that mobile and online banking, just like an Apple Watch, right? Am I completing my rings? Am I doing the things that I need to do on a monthly basis? And what if I want to go back and I want to see what was paid out to me? So a lot of consumer education, a lot of engagement, almost gamifying the whole experience for that consumer to be even more engaged. And then what if, we talked about indirect portfolios. What if instead of 6% on the promoted rate, we did 5%, and then it went to 6% if you had a loan with the institution? Guess what that gets you the opportunity to do? Call loan only, mortgage only, auto loan only, whatever, indirect only relationships, and say, hey, guess what? Because you're a valued customer or member of our institution, you get 6% on your checking account. You're going to get higher loans. You're going to get more attachment. Our institutions who have done that have had a 9% conversion rate. I used to cold call institutions at one of the credit unions I worked at. Guess what our conversion rate was? Less than 0.5%. And they weren't engaged relationships. These are 9% conversion, indirect only, standalone only type relationships that brought a checking account and deposits with them and were qualifying. Right? So these are truly a good conversion of getting more value out of those existing consumer relationships. And then what if on top of that, not just that they had the loan, but you could add a feature to that loan that said, hey, if you pay ahead, Mr. Consumer, at any time you can adjust your auto pay. And let's say that in this example, your promissory note makes your payment $598. You pay $700 a month because you want to see what that looks like. In real time, you could see, okay, well, how fast am I going to pay down my loan? How much interest expense am I saving? And then what if we could track for your institution how much they've paid ahead, which is that $1,400, and we created what was called a take-back balance, which as long as it doesn't exceed the original amortization schedule, that consumer, if there's an emergency that comes up, can go in and take back those balances within a click of a button, have that show up in their checking account. You don't have to re-am the loan. You don't have to re-underwrite it. right? It allows you this experience where consumers get to know and understand their debt in a cool way, which makes the CFP be happy, and you get more profitable, more engaged relationships. And what we found is that institutions that have this type of a feature, that have this type of engagement on their loan portfolio alone, see lower delinquency. They see about a 6 times increase in terms of attachment of checking relationship. And what they also see is that auto pay is 84% without a yield discount of any kind, right? So what you're trying to do is figure out, how do I bring both sides? How do I bring the products both on the consumer deposit side or business deposit side, and then lending side? How do I bring that together in a digital experience that's really engaging? So as I've been talking, some of the folks in the room, and this is more common of CFOs and others than not, but as soon as I say 6% or 4%, they freak out a little and they get a little nervous. So I want to really quick show you how that works. So let's say in this example that instead of 6%, it's 5.5% if they qualify up to that first 20,000, and then above that is 100 basis points, and if they don't qualify, it's still free. They get 5 basis points. Well, what we find after doing this for the last 20 years is while we encourage consumer behavior, there's going to be about 22% of deposit dollars any given month that don't qualify for whatever reason. It's not usually the same consumers, and not qualified doesn't mean they're not profitable. It doesn't mean they're not engaged with you, but it does happen. And then there's about 33% of deposits that are going to be above that capped dollar amount. And so what ends up happening is while you have a promoted yield of 5.5% or 6%, the real cost of funds in this example is only 306 basis points. Right now, most institutions I go to, and I say, how many dollars do you want for 300 basis points? They're like, all the dollars, right? But we also know that there's additional income. There's debit card engagement. While you're asking somebody to swipe 15 times in this checking account, they'll actually swipe on average around 36. And then you'll get people like me who are your hyper swipers. When I consolidated my account, guess what? I have 4 kids. 3 of those are teenagers. Do y'all know how much money I spend on them? Gas money, all those kinds of things. We swipe about 130 times, if not more, every single month. So do you think my institution really likes that non-interest income? Absolutely. From an interchange perspective. And a lot of institutions I talk to that are running into some interchange limitations, especially as we think about, the Durbin Amendment and all of those, you have to think about, am I getting more swipes? If my amount per swipe is going to go down and it's going to be pinched, why wouldn't I want more swipes with higher spend amounts so that I can maximize as much of that revenue as I can and get core deposits so I'm saving on interest expense? That's one of the better ways to kind of dodge a little bit of how that's happening. So your overall cost after you add non-interest income and expense, the non-interest expense is those ATM refunds, any fee that our clients pay to us. Your all-in cost of those deposits is still 199 basis points. And when you compare that to a CD, this is an example. Let's say that I'm driving in $74 million of net new deposits. My promoted rate on my high yield account is 550 basis points versus a 5% CD. Because of that non-qual rate and above cap dollars, I'm automatically already saving. And so that's how I get down to my 306. And then if I also look at the fact that I have some non-interest expense, so again, ATM refund expense, fees that you pay to us, paper statement, e-statement costs, right? And then offset that with that non-interest income. A lot of that, again, majority of this is debit card interchange. So this is not about like NSF. This is not about any of that. It's about debit card interchange and making sure that you're getting that throw off from that consumer. So from an annual marginal cash flow, this is pretty substantial. 5% funding cost versus 199. And as you're thinking about that, it's not just the profitability side of it that's important. When you're looking at that high-yield checking account, and this is the slide that my CMO loves, if you're looking at that high-yield checking account, 199 basis points, you're getting a consumer that's really happy. They're engaged. They're going to refer you. They're going to tell their family and friends. They're going to brag about it and show on the app that they got this little thing that they can see on their loan, right? And we actually see that in that mobile engagement, about a 3 to 4 minute user experience. When's the last time that a customer or a member spent 3 to 4 minutes in your app? Right? It doesn't happen. So what you're doing is you're getting somebody who's really happy, whereas with a CD, you're getting somebody who's complacent. Again, here today, gone tomorrow. So it's not that you don't want to market them, but it's like, why wouldn't you want to pick something that's better for your balance sheet, better for your consumer, and way more fun to market, right? At the end of the day, after doing this for 20 years, that's not where you can stop. There's a lot of other stuff that goes into it. A big part of what we do in the go-to-market is consumer segmentation, making sure that we are getting the right product to the right person down to zip code level. After working with hundreds of institutions, the strategy for every institution is different. Our smallest partner is like a $30 million institution, and we have, talked to institutions 20, 25 billion. right? So every institution is very, very different in how they want to look at that. So your product, your mix, your design, we want to make sure that you have assets that we can use that consumer testing to give guidance on what do consumers respond to, what's going to actually cause them to move. And then we want to make sure that we have everything from creative assets to community kits to regulatory. We have a generator, a reg gen, that within seconds can generate disclosures for these types of products. And we're right now expanding that on other products as well. And then at the end of the day, I think what's most important is having the data and analytics, but knowing what to do with it. So in my last few minutes, I want to kind of share with you guys an example of how this actually comes to life. So this, the dedicated regional resource that I think is the most important in managing surprises is our client director team. As the chief growth officer, I have the awesome opportunity of running our client success team, and these people are one of the most important components of that because all of these guys come from banking backgrounds. They're all balance sheet certified. They will only support a maximum of 30 clients at a time. They're physically out in the field on a regular basis, in the branches, in the executive team headquarters, right? And their job is to deliver on the results that we talk about. And we do that through a lot of different ways, and it's not like, it's really just part of the program and the performance. So I'll give you an example. We had a $4 billion institution. During the performa, we projected they'd open about 12,000 accounts in the first year. They opened 17. Woohoo, we crushed it, right? We set on average swipe amounts based on their current swipe volumes that they'd get about 2 more swipes per account after that first year. They did it. You guys are not going to be shocked that I'm sharing, hey, great things. Well, what happens when it goes wrong? Well, our projections on deposits were that they'd grow 75 million, and they were on track to do 64. Ruh-roh, that's about 10.6 million off track. Well, that's not good. What happened? Well, what we found is the client director, in one of the analyses, they have access to over 50 ad hoc tools that we basically take the institution's data, benchmark that against about 15 million accounts, and the data that comes flowing into that to say like or similar, what should we expect? Let's go back to trend data, like or similar time periods, zip codes, all those things, right? So they have access to about these 50 ad hoc tools that they use to consult our clients. And what they identified is the product design needed updated. There had been some major shifts in rates in the area. Their frontline wasn't leading with KASASA. What was happening is at the frontline, somebody would come in, or the KASASA products, somebody would come in and they'd say 50% of the time, I'm just gonna put you in the free account. Well, what was the problem with that? The free account, if it was 50-50, the free account was bleeding. The attrition was huge. Just as many as they were putting in were coming out the bottom. They were losing $12 million a month in deposits in that account. So while we were bringing in a lot more in the door, you guys saw that first stat, they were putting them in the wrong accounts. The consumer had no reason to stay with them, and so they weren't actually going through the effort of switching over their program, so it fell out the bottom. And so what are they doing? Dumping more in the top. And so what we ended up doing is realizing, hey, we got a problem there. So we worked with the front line. The other problem is they were moving out non-qualified accounts because they didn't want to pay us for them. They're like, well, clearly they don't see the volume and the importance of that. Well, they moved out those accounts, and guess what they did? Ticked off a lot of people, right? And so they ended up losing quite a bit. The other piece is that we saw significant frontline turnover. That's a big thing that we're seeing in the industry with COVID and all the different pieces. And so we had to go out there and do a retrain. So we changed the product design. We came up with a new go-to-market plan, sent boots on the ground to go out there. We meet with them regularly, did a retrain, got them back on track, and we changed their overall deposit trajectory from losing 4.3 million, because of that hole in their free checking bucket, to going on a trajectory of 71 million, and they just ended this last year at over 150 million of net new deposit dollars at less than 2% funding cost. So do you think they're a happy client? Yes, they are, right? So very good. That is my time. I now only have 42 seconds, so I appreciate you guys. If you want to chat with us, get more information, Vanessa's in the back. We are giving away a $100 gift card if y'all want to come say hi to us. All right, awesome. Thank you, guys.